Picture this, 6.22 lakh crores. That's the amount India plans to spend on defense in this fiscal year. This isn't just a number. It reflects the growing importance that's placed on strengthening India's defense capabilities, isn't it? And the focus doesn't stop there. By 2029, India aims to triple its defense production to 3 lakh crores and increase its defense exports to 50,000 crores. But why is the defense sector in focus? India has been working to become more self-reliant, especially in sectors like defense. The Atmanirbhar Bharat initiative is pushing for more domestic production, reducing reliance on imports and encouraging local companies to produce more. Last year, India's defense production grew by 16.8%, supported by both public as well as private companies. A major driver behind this growth is government spending. The 6.22 lakh crore budget for defense, which accounts for 13.04% of the national budget, is aimed at modernizing equipment, upgrading technology, and boosting India's defense capabilities. This goes beyond security. It's about laying the foundation for future growth, including exports. Which brings us to the next question. How can you be a part of this growth? Now, while you could invest in individual defense stocks, there's an option to invest in the defense sector via an ETF as well. Groww Mutual Fund has introduced the Groww Nifty India Defense ETF, which seeks to track the Groww Nifty India Defense Index. This index includes 15 companies involved in India's defense sector, covering production services and technology. The Groww Nifty India Defense ETF seeks to hold the same stocks in the same weightage as the index. These companies come from both public sector, making up for 67%, and the private sector, making up for 33%, offering exposure to different parts of the industry. The ETF includes companies of various sizes: 41.5% large cap, 38% mid cap, and 20.4% small cap. Some of these companies have strong order books, meaning they have future projects lined up, giving them some visibility into future revenue. An ETF trades like a stock, meaning you can buy or sell it on an exchange. You will need a demat account to do this. Essentially, Groww Nifty India Defense ETF aims to offer exposure to several companies in the defense sector through a single investment without the need to track and trade individual stocks. In addition to the ETF, Groww Mutual Fund has also introduced the Groww Nifty India Defense ETF FOF. This fund of funds seeks to invest in units of Groww Nifty India Defense ETF. The fund of fund may be considered by those who prefer to invest through a mutual fund structure rather than directly in ETFs. It can also be an option for investors who do not have a demat account or who want to set up an SIP to invest regularly in the defense sector. India's defense sector is in a phase of growth, supported by increasing government investments and expanding export opportunities. Now, whether you choose the ETF for direct exposure or the fund of funds for a mutual fund structure, both options aim to offer a way to participate in the sector's growth. If you're considering ways to invest in one of India's key sectors, the Groww Nifty India Defense ETF or the Groww Nifty India Defense ETF FOF are options you may want to explore. The NFO for both schemes is open till 4th October and you can see all the details on your screen. Thank you for watching, and remember, it's always a good idea to consult with a financial advisor before making any investment decisions. If you enjoyed this video, do not forget to subscribe to the Groww Mutual Fund channel, and do let us know your thoughts on India's defense sector in the comment section below.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.